Hello and welcome to the Fort Detrick Business Development Office Government Contracting Webinar Series. Today's session is Pricing Strategies to Win, Profit, and Perform. Hello everyone, my name is Gloria Larkin and I'm President of TargetGov. We're honored today to be able to present the webinar series with Fort Detrick Business Development Office. I'd like to welcome Steve Lamberson, Business Development Specialist with the FDBDO. Hi, Steve. Glad you're here.
Hi, Gloria. Thank you very much. And I'd like to thank Mike Gallo for joining us today and sharing his presentation on proposal pricing strategies with us. So, Mike, thank you for joining us today.
My pleasure.
Absolutely. Let me have your attention for just a few webinar notes, and then we'll jump in with Mike's presentation. I'd like you to know that we are recording today's live webinar to make it available to you for future access 24/7 at your convenience. And due to the number of attendees today, so that we can answer everyone's question, we're going to ask you to email your questions to us. You can see the email at the bottom right-hand corner of your slide, ask@fdbdo.com. We promise to answer every question asked, either during today's live session or if you are hearing this as a recording, you can send your questions in 24/7. We will reply with a personal answer. And if you have any problems at all while you're on the line, please call our office number at 301-620-7071. The next hour is going to be full of great information, so let's go ahead and get started with the Fort Detrick Business Development Office webinar, Pricing Strategies to Win, Profit, and Perform. I'd like to introduce our subject matter expert today. Michael Gallo is founder and president of Valeris Consulting. He has over 20 years of experience providing analytical insights to senior decision-making clients in the Department of Defense. Many of his clients were responsible for large multi-billion-dollar capital investment and program acquisition decisions. Mike established his business so smaller clients could tap his extensive knowledge and experience analyzing, modeling, and communicating capital investment, pricing, and financial business decisions. His mission is to help managers, directors, and executives harvest their organizational knowledge and build products, projects, and services that are winnable, profitable, and sustainable. Welcome, Mike. I'd like to hand the slides over to you.
Steve, Gloria, thank you very much. Welcome to everyone to today's webinar on proposal pricing strategies. Again, I'm Mike Gallo, president of Valeris Consulting. Before we start, let me say that today's seminar is intended to provide you with some basic concepts, advice, and strategies for pricing your contracts. This seminar is not intended to provide specific guidance on compliance with the Federal Acquisition Regulation, or FAR. With that said, let's get started. Here's what I'd like to cover today. There's a lot you can consider when developing your pricing strategy, and we can't cover all that detail during our brief webinar today. What I want to do is touch on some basic concepts that include pricing approaches, price components, pricing strategy, some pricing practices to consider, and finally some winning pricing tips. By the end of this webinar, I hope you gain some insights and useful tips on proposal pricing strategies that you can put to good use on your next contract bid. So let's go ahead and move forward. Before we talk about our first topic, pricing approaches, I want to ask the following question rhetorically. Is there any one key to success when developing pricing strategy? I'm not sure that there is one magic answer for ensuring pricing success, but let me offer you what I would regard as a recipe. That to be successful in pricing strategy, you have to accomplish two things at the same time. First, you have to set a price for your goods and services that's greater than your costs. That seems pretty obvious. But simultaneously, you have to make sure that the value of what you offer your customer is greater than the price you want to charge your customer. Now, you, as the seller, you're in control of both your pricing offer and the costs to deliver those goods and services. But it's the customer who's going to determine the value. Value is whatever the customer perceives to be of importance. So to win the sale, customers must perceive that the value of your offering is greater than the price they pay. And if you get this recipe just right, you're on your way to winning, profiting, and performing on your federal contracts. So what are some of the objectives of pricing strategy? Well, obviously our main objective is to set a price that motivates the buyer to buy our products, our goods and services. But are there more objectives to consider in your pricing strategy? And I think there are several additional objectives you need to consider. First, hey, what about the other guy? Not only does your price have to be low enough to cause the buyer to buy, it has to be low enough to ensure that the customer chooses you over the competition. But you can't go too low, or else you won't recoup your direct and indirect costs. And then separately, you need to consider profit. And I'm going to talk about profit in a little bit. And I'm going to assert that we need to be thinking about profit beforehand and how it affects our pricing. And finally, sometimes your pricing strategy is actually part of your marketing strategy. A seller might set their price high to make a statement that their products and services are superior to their competitors, or they'll use their price to set a premium to establish their brand in the market and to make their brand very select and exclusive to a market segment. And you would see this when we're talking about luxury goods and services. But regardless, recall the customer only buys when they believe the value they receive exceeds the price they pay. So don't forget the recipe: value, price, cost. If you're going to meet all the objectives of pricing, you have to consider not only your price, you'll also have to consider increasing the buyer's perception of value and exploring options that decrease your costs. Okay, let's talk about some basic pricing approaches. I'm going to briefly highlight three approaches, but then focus our talk on the first approach, using build-up to establish price. So let's review the last two approaches first. Auction-based pricing lets buyers decide the final price of the transactions. The seller can play a small role, like setting the minimum price reserve they're willing to accept, but it's the buyers who bid up the price in order to win the right to purchase our product or service. And a good example of an auction-based pricing scheme is our stock market. The last example on the slide, market-based pricing, is used to set a price based on the price that others are selling their goods and services in the market. So your retail stores, for example, that claim that they won't be undersold, ! They'll tell the buyer that they'll beat or match their competitor's price. So that's an example of market-based pricing. But you have to be careful. Market-based pricing can also become disconnected from the seller's costs, and then at that point it becomes irrational. When we talk about companies entering price wars, like the airline industry, we're witnessing market-based pricing in action, and we're also witnessing how destructive those pricing schemes can be to their businesses. So the one advantage of our final example, build-up approach, and the one we'll spend more time on, is in a build-up approach, we establish our price based on our detailed understanding of our costs to provide our goods and services. So each of these approaches have benefits and drawbacks, but in the end, it still boils down to the basic recipe of ensuring that the price you're offering your goods and services is greater than your costs. And if you don't do that, you'll soon be out of business. Okay, let's talk about price buildup. We're going to review the basic components of price, and I'm going to try and do this without turning it into a full-blown cost accounting class. We're just going to try and cover the basics. So we can think of price as the simple buildup of three high-level pieces: direct costs, indirect costs, and profit. Now, for anyone new to federal government marketplace, the notion of thinking of profit as a component to build up your price might seem a little backwards. That's especially true if you're accustomed to establishing a market-based price first to penetrate the market, and then figuring out later how to minimize your costs over time to maximize profit. If you're used to that type of market-based pricing, let me ask that you open your mind a little and consider profit as another element of our price as we review each part of our price components individually. Okay, our first price component is direct costs. Direct costs are everything that you can attribute to a specific product or service. So if you bid on a project for professional services, for example, your direct costs would include things like your project staff's wages, some or all of your project manager's wages for the time they spent on the project, and any expenses that directly apply to the project, such as travel expenses if you're going to travel to provide a client presentation on the project. If you're in a manufacturing environment, direct costs would include things like factory touch labor, which is needed to assemble the product, and the product's bill of material. Those would be two examples in the manufacturing environment. So basically, if the cost can be substantially attributed to a product, service, or project, it's a direct cost. Okay, conversely, our second price component, indirect costs, can't be tied to specific products and services because these costs are shared. We could think of indirect costs in three broad categories: fixed, variable, and what I call discretionary. And let's review each of those just a little bit. Fixed indirect costs are those costs that don't change much based on the volume of business. So your rent cost, for example, is a good example of a fixed indirect cost. It doesn't necessarily go up or down as you have more or less business. Some other example of fixed indirect costs might include depreciation, interest expense, a license fee, and executive and general management compensation. The second category of indirect costs, variable indirect costs, will change somewhat based on your volume of business. A great example of a variable indirect cost is employee fringe benefits. Generally, bringing in more business means hiring more employees, which means we're paying them more for fringe benefits. Other examples might include desktop computers and associated software expenses, and perhaps certain other kinds of leasing expenses, for example, maybe a fleet lease, where more business means more delivery vehicles are needed. Finally, I include a category that I call discretionary indirect costs. These costs reflect priorities and strategies of your business plan. These are costs that you can think of as related to management decisions to execute that plan. So some examples of indirect discretionary costs might include employee recruiting, training, marketing, advertising, bonus, and other incentive compensation. When we're going to build our price for a specific product or service, we're going to allocate a portion of these total indirect costs based on rules set up by our accountants. And that's as far as we'll take that discussion for today's presentation on cost allocation. There's really an important point I want to make about your indirect costs and pricing strategy. If you're going after a large contract, it's possible that many of your indirect expenses will be affected. For example, you might end up paying more rent for more office space that you need to accommodate all the employees that you hire if you win the big contract. So make sure your pricing strategy considers the impacts of large contract wins that they can have on your indirect costs. Finally, let's talk about profit, our final pricing component. We can view profit in two ways, and I think the prevalent view is to see profit as an output, as a byproduct of business performance that measures the difference between sales income and expenses. But we shouldn't view profit only as an output. We ought to take a look at profit as an input into our pricing strategy. And why might we want to look at it this way? And I think the answer lies in understanding what some of the uses and purposes are for profit. And the first use, and the most obvious, is the reward or return on investment to those who risked their investment capital in the business venture, like shareholders. Profit's also a source of capital for growing your firm. How do you want to fund your growth? You can do it with debt, you can do it with equity, or you can do it with profits, which we would then call retained earnings. You know, right now, debt financing is cheap if you can get a bank to give you a loan. And the same is true with the stock market. So profit offers businesses an added degree of control and certainty about growing their business. Profit sharing, another example of a means to motivate and reward employee performance. And finally, let's face it, we're in a less certain business climate today. So your profits permit your business venture to build up some cash reserves to hedge against our uncertain business climate. So when we look at all the uses of profit, it's not too hard to see that getting more of it is better for growing, improving, and protecting your business. So although you might be tempted to lower your price to ensure a contract win by lowering your profit, put some forethought into profit and make sure there's enough financial gain to help you meet your business objectives. Okay, I want to talk a little bit more about this issue of business uncertainty. I said that profit serves as a cushion against uncertainty. And if you think about this a little bit, your pricing strategy has a lot of assumptions built into it. Those assumptions are based on business forecasts. And those forecasts are never perfect because they're a prediction of the future. So your business is kind of in a chicken or the egg dilemma. You have to have people, materials, and other resources to provide goods and services to sell to customers, and that costs money. But you also need to know how much business you think you'll generate. So ultimately, your pricing strategy is some sort of balance between your forecast of the cost of your services and an estimate of the revenues you generate over time, like a fiscal year. A financial forecasting model of your business's revenues, cash flow, direct costs, and indirect costs is useful to help you organize and analyze and understand how your company transforms those resources into revenue and income. A forecasting model is an important part of your pricing strategy that can help you determine your break-even points to assess how much risk you might be taking in your pricing. Let's take a quick look at an example of the concept of a break-even point. So let's walk through a simple example of Fred's Pizza. Fred's the owner, and he has forecast that his business will incur $60,000 of direct costs and $75,000 of direct costs over the next 12 months. So his total costs that he expects are $135,000. Now, Fred is also concerned about keeping his price competitive. So he fixes the price of his pizzas at $10 a piece. So for Fred to break even in this scenario on his costs, he'll have to sell $135,000 divided by 10, or 13,500 pizzas. Then assuming Fred has any time and ingredients left after making all those pizzas, any additional pizzas he sells will represent profit to his business. Now, alternately, Fred could have also thought that maybe he actually knows how many pizzas he can sell in a year. And let's say in this example, he thinks he can sell 10,000 pizzas. Then assuming the same costs, he would have to charge on average $13.50 for each pizza just to recoup all his costs for his business. Now, obviously in a real business case, this analysis is more complex. So again, taking the time to build a model of your business allows owners to systematically evaluate how the business forecast, the sales mix, and their pricing strategy can affect their business's financial performance. So the main lesson here for pricing is to think about putting together your own business forecast model to help you make better pricing decisions. Now, we're in the federal marketplace, so your pricing strategy can also depend on the type of government contract that you're bidding on. There are 3 basic contract types, and I'm not going to go into significant detail about all the ins and outs of the contract types in this seminar today. We're just going to briefly touch on each. The first 2 contract types are used when the product or service can't be specified exactly and there's potential for funding to run out before the total product can be delivered. So cost type and time and material contracts fall into that. Cost type contracts are essentially a buildup of costs the buyer, in this case the government, considers allowable. Then a profit or fee is negotiated and put on top of those costs to arrive at a final price. And in government contracting for cost-type contracts, this profit's usually no more than about 10% on allowable costs. Now, time and materials contracts use pre-negotiated labor rates that are organized by labor category. And these pre-negotiated labor rates are already, quote-unquote, fully loaded, meaning that the rate reflects the contractor's direct costs and indirect costs along with the contractor's inclusion of profit. Now, the last category, fixed price contracts, perhaps is the most important for the sellers. In this arrangement, the seller agrees to provide exactly the product or service specified for an agreed-upon firm fixed price. Fixed price contracts represent more risk to sellers, and they need to ensure that they've done a good job forecasting costs. That's because in firm fixed price contracts, any additional expenses incurred by you, the seller, to deliver those goods and services will not be paid by the client. So that's the bad part. But there is the possibility of the flip side to that, and that is there's an opportunity for additional reward. If the seller can avoid or lower their costs without degrading and making sure they fully deliver on what was promised, if they can lower their costs, it will mean additional profit in the seller's pocket. So let's explore some other pricing factors to consider in your bid. There are way more pricing factors to consider than we can possibly cover in this short session today. And many pricing factors will be specific to your industry and the types of products and services offered. Let's review a couple that are broadly applicable. For most companies, labor-related expenses are the largest portion of their direct and consequently indirect costs. So changes in labor expenses will have a sizable impact on pricing. So what might those possible changes in labor expenses be? Well, certainly any changes in our benefit policies are going to affect our labor expenses. And given today's climate and recent changes in our healthcare laws, this is a good example of a possible impact on our benefit expenses. Pay raises and promotions of staff will affect your labor costs. How do you account for that in your pricing strategy? And how about attrition? If you have a fair amount of staff turnover, then recruiting, training, and productivity impacts will influence your pricing strategy. And another pricing consideration that we may want to look at is make versus buy or insourcing versus outsourcing. Is it less expensive to have another business provide a key part or service, or does it make sense for your business to retain production of a part or delivery of a service with in-house resources. These types of decisions can also affect your price. Does your business make things or provide a repetitive service? Then you might consider factors such as economic order quantity, process improvement, tools, automation, or learning curve theory that can beneficially lower the average unit costs of these multiple items and services you're producing. Some of these impacts, like learning theory, though, require collection and analysis of your historical data to quantify the size of that beneficial impact on unit cost. And then other factors, like process improvement, have benefits, but also may require an additional investment. So you may need to look at performing a separate analysis to ensure that the expected size of the process improvement benefit outweighs the size of the investment that you're making. I hope you're beginning to see that there's a lot of analyzing, forecasting, and modeling that you can do to better understand and improve the results of your pricing strategy. Let's look at some additional practices to consider for sound pricing. So what are some good pricing practices? Well, in terms of direct costs, you really want to ensure you understand the full scope of contract requirements. If you don't fully understand the requirements, you might be at risk of underestimating the amount of direct costs required to deliver the product or service. So, for example, if you're bidding on an IT project, you might want to ensure that you fully understand the level of new development required, because that will impact the amount of testing to perform on the project, and that will ultimately affect testing costs. In terms of indirect costs, as I previously mentioned, be careful if you're bidding on a relatively large contract for your operation. Make sure you consider what happens to your indirect costs if you win that large order. Now, the next item is important. Don't blindly rely on your hunches or rules of thumb for your pricing. And yes, for you owners and founders out there, if you've been in business for a while, I'm sure your sense of the resources needed to do the job are actually pretty good. But really, you should use your accounting, project engineering, and other data as a means to develop sound pricing that's based on actual performance. Your data backs up and confirms those rules of thumb. Now, I'll give you 2 good reasons why you should think about doing this. First is, what happens if you are not there to put the price quote together? Are your lieutenants and your staff's thumbs as good as yours? Maybe they are, maybe they're not. So having access to that data and using that in your pricing will give you some measure of assurance that you're going to have a good price. And number 2, collecting and using your own data is a great way to perform a sanity check on your pricing strategy. So with that data, you can ask the question and get an answer to how low can you safely go in your pricing and still get the job done. Now, the next item, your pricing should build in reserves and contingencies. So for reserves, think of reserves as building in an error margin for pricing areas that required an estimated input of quantity. So, for example, if you were building a contract to install a new wood floor, your price would include an estimate of material that also builds in a little bit more than what's needed. And this type of reserve is a hedge against mismeasurement, defective parts, or any rework as a result of maybe breaking the part accidentally. You can think of contingencies as a hedged bet. When the work or solutions are uncertain, consider identifying alternate paths and or contingencies, and then build in additional reserves into your price. So an example here would be, let's say you have a contractor that's coming in, and they're going to price a bathroom remodeling. The contractor will more than likely include a pricing contingency for lead testing and abatement if the customer's home is an older home, but the presence of lead paint is not known. So they'll build in a contingency into their price quote. Other reserves and contingencies to consider are scrap. We talked about rework a little bit already, and retesting costs. All of this goes to suggest the following rule when pricing your contracts. Never assume 100% success in your pricing. Build in some reserves and contingencies. Finally, I wanted to say one more point. Finally, consider formalizing and standardizing your pricing strategy in a pricing model. It really helps you keep organized and can help you produce consistent and objective price quotes. You don't have to invest a lot of money in a model. It doesn't have to be expensive. You can start with a simple Excel model and then you build from there. The two most important parts of your model are your own underlying past performance data and the knowledge you possess about your business's products, services, and operations. The more knowledge and data that you can place in the pricing tool, the better the tool will perform for you. We're getting now close to the end of the presentation, so let's take a moment to consider some winning pricing strategies. Now we're ready for the next slide. Well, believe it or not, I recommend one of the winning pricing strategies is you get in the habit of documenting your pricing assumptions. Why do that? Well, when your customer pushes back on your pricing, you'll have the ability to intelligently discuss assumptions you made in your pricing. And by documenting and discussing those assumptions, you help both yourself and the buyer shift this pricing discussion to one of clarifying those assumptions and making trade-offs. So when the buyer thinks the price is too high, you can review those assumptions and jointly uncover areas where the buyer might be willing to relax a requirement or two to get a lower price. And also, as you graduate into larger federal contracts, it becomes increasingly important for the government to understand how you arrived at your price. Now, the next tactic might not always be possible in federal contracting, but if you can, try to provide the buyer with options. Think about your Home Depot store and how they sell their products to consumers. They almost always categorize their products into good, better, and best. Home Depot is trying to help you, the buyer, understand the things that differentiate value and price. And I think this is a great way to give the buyer a range to help them understand that value. And it takes some of the guesswork also out of bidding. So if you follow Home Depot's recipe, for example, your low price offer could reflect a bare bones minimum meeting the buyer's requirement. And the medium price offer might reflect that plus a little bit more value, let's say pretty good. And then perhaps your high price, your best value option, can reflect a maximum of value for both you and the buyer. The next point is also another one that might be hard to do in an arm's length government contracting arrangement. But the next point is try and question requirements, especially if they look what I would call gold-plated. And we use this term gold-plated to describe requirements that are expensive for the seller to fully satisfy over an alternative that might not quite 100% satisfy the requirement, but would be significantly less costly to implement. So sometimes the buyer identifies these high level of needs and they're absolutely necessary. But other times, maybe that high level of need is not absolutely necessary, and the customer might save a lot of money if they could relax the requirement somewhat. So how do you know if the buyer is willing to settle for less in order to get that better price? You got to find ways to ask them. Before a solicitation is released, talk to the buyer and the contracting officer. If the government releases requests for information to understand the market, respond. And if the government releases a draft statement of work for review and comment by industry, use that as an opportunity to provide feedback. These are all chances to let the buyer know your thoughts about the requirements. Now, the next tip, consider discounting your price when you don't think you have the superior solution. So when you discount, you want to make the other guy justify what now looks like a premium to your price offer. So when you do that, sometimes the buyer won't believe or perceive that the extra value of your competitor's higher price solution is enough to justify that higher price. And when that happens, you win. So remember, value is in the eye of the buyer. Finally, it should be obvious that we have to consider our competitors' pricing behavior in our own pricing strategy. And I have two separate thoughts on this. First, the federal government is becoming more transparent with its contracts and purchases. And there's a lot of information on basic contract award values that's now available on the internet for free. One resource, one place you can go to check out this information is usaspending, all one word, .gov, G-O-V. You can get a lot of good information on prime contracts awarded by the federal government, and they've also recently added information on subcontract awards as well. You can learn a lot about your competitors' labor pricing and structure by analyzing their GSA contract information if they have a GSA contract. You can visit gsa.gov and learn more about your competitors' advertised time and material labor rates by reviewing their GSA contract labor schedules. Finally, for very large contracts, you may want to consider retaining the services of a specialized consultant who can provide what's known as price-to-win services. These consultants will provide a non-advocate assessment of your competitors' likely behavior, their pricing behavior, to help you determine a target that your price bid needs to come under in order to win the contract. Well, that's all the time we have for today's presentation, and I want to thank you for attending today's presentation. Thank you.
No, really, thank you. We appreciate your expertise, your abilities, the information that you've brought to us today, Mike. And Steve, I know you've got some questions that have come in. Would you like to roll right into those?
Yeah, thank you, Gloria. Let's start with the first question. All right, Mike?
Sure. Go right ahead.
First question. Are there software tools available to help with pricing?
Yes, the answer is absolutely yes. There are software tools available, and they come in both a generalized and a specialized form, and they usually also can be specific to the industry. So, for example, construction industry might have specialized pricing tools for pricing proposals in the construction industry. There are also specialized tools in the federal government sector that are built with the specific purpose of organizing and integrating pricing proposals for large pricing efforts. What I would say, though, in my professional opinion, is that before companies go out and spend lots of money on pricing tools, first take the time to focus on collecting and understanding their own data before going out and making those investments in those pricing tools. I think spending time and money on your own data can pay a lot of dividends for that company down the road.
Okay. All right, good. Another question. Actually, this one's a comment, or I think they're looking for a response to their statement. It says, I didn't see you mention fixed costs when talking about direct costs.
That's a good catch. I made the presentation a little bit efficient for time's sake. But yes, absolutely, you can have fixed direct costs to consider as well. And from my background in DoD, an example of fixed direct costs might be tooling and test equipment. So those types of costs don't necessarily change as you increase the number of units produced in a contract or project. So yes, absolutely, you can have fixed costs on the direct side as well.
Okay. All right. Also, question 3, you mentioned something called learning theory. How is that related to pricing?
Yeah, that's another term that we used heavily in the DoD sector. It's a concept from manufacturing, and it's this. Let me see if I can say it this way. As processes are repeated, people become more proficient and more productive. And then when that happens, it takes less time for people to accomplish those repeated tasks. So the unit cost consequently will come down as they build more units. So a learning theory is expressed as you double the amount of things that you're doing or producing, the unit cost will drop by a fixed percentage. So if I said there was a 90% learning theory, that would mean that when I go from, let's say, 2 units to 4, the price is going to drop 10%. And if I build 4 more additional units, I go from 4 to 8, my unit price will drop an additional 10%. So that's what learning theory does for you.
Okay. All right. I've got a couple more, Gloria, if we have some time.
We do.
All right. Mike, what is your definition of a good price?
Yeah. I would go back to what I said at the beginning of the presentation. If the customer clearly understands the value of your offering and agrees to pay the price that you've specified, and that price is greater than the cost to deliver the service, and I would say you have a good price. But the key to all of that is to make sure that you fully understand what it is the customer wants, and that you fully understand what it's going to take in terms of your resources to deliver that to the customer. So really understanding what it's ultimately going to take in terms of your costs, then I think you have a good price.
All right. Let's see. I've got one more question. Are there any other benefits that justifies your recommendation for the audience to consider building or buying a pricing model?
Well, first and foremost, I think the pricing model, this is usually built on data, is going to increase the accuracy and credibility of your pricing. But I think in addition to that, there's certainly going to be the advantage of speed. And anyone who's ever had to put a pricing proposal together and in crunch time, coming up against a proposal deadline, will really appreciate how having an automated tool to generate price quotes can be very invaluable when you're making those last-minute adjustments before the proposal deadline. And typically, the way the models are set up, you're making conscious decisions about key inputs into your pricing. So there's I would say some additional maybe objectivity when you're using a model to do your pricing. And the other thing I would say is a lot of the math has already been built in to those pricing models. So especially when you're at crunch time and you're trying to get the proposal out the door, using a tool or a model will hopefully lower the likelihood that you're going to commit a computation error in your pricing. So I would say speed and hopefully more accuracy and less errors are all advantages of using a pricing model.
Mm-hmm. Okay, good. Well, thank you, Mike. Gloria, did you have any?
We had some questions come in. One of them says that we've already quoted a price on an RFP. Now the contracting officer wants us to defend our price. What does that mean?
Yeah, that means they would like you to provide a basis of estimate for how you arrived at your price. And it could mean a variety of things, but the bottom line is you provided a price. They want to see what you based that price on. What historical data and evidence can you provide to the contracting officer to justify the price that you proposed? And again, I would mention in my earlier part of the presentation, we talked about documenting assumptions. So not only is your pricing based on some underlying history of what it's taken to do the work or deliver the service, but a lot of times there's some imprecision in the bidder's understanding of the buyer's requirement. And when you have that imprecision and understanding, you're going to make assumptions. So again, documenting those assumptions and then bringing those forward is a useful means for you to have that conversation about why your price is what it is. And you're hopefully giving the contracting officer some comfort that your pricing isn't arbitrary.
Thank you very much. I have one last question that has come in. And remember, if you're listening to this as a recording and you want to ask Mike specific questions, you can email him directly at the email address that's noted on your slide. And always you can send your questions in to ask@fdbdo.com for this session or any of the other webinars through the Fort Detrick Business Development Office. Okay, Mike, here we go. This is the last question for today's session.
Okay.
And it's kind of a doozy because it's real life.
Okay.
And it says, can't I just use a winning competitor's price, cut it a little bit to win the bid, and then back into all of the pricing requirements?
Yeah, that's kind of like my last point, what would be known as price to win. And you really could consider it a form of market-based pricing. If I have an idea what the lowest bidder is going to bid in the market, I want to come in under that, and then I'll worry later about what it's going to take to deliver. I think that's a very dangerous approach if you absolutely don't fully understand the client's requirements and you absolutely don't fully understand what it's going to take to deliver against those requirements. So you're essentially ignoring your historical data, your actual performance history, and then are going to go back after the fact and attempt to cobble together a project plan that hopefully comes under the bid that you've made and will still give the client a product or service that they'll be fully satisfied with. I think the road is strewn with the dead bodies, so to speak, of contractors and projects that lowballed their price to the client, to the government, in an attempt to win the business, and then they suffered the consequences down the road when they weren't able to deliver those products or services at the price they bid. So they either had to somehow get a adjustment to their price, or they delivered a deficient product or service to the client, and it'll ultimately be detrimental not only to the people who they sold it to, but to their own reputation. So I would be very, very careful and always have some other means to back up and have a sanity check on using these price-to-win strategies, and make absolutely sure you have a second opinion that says you can actually deliver at that specified price.
Mike, that is advice that should be the best advice that anyone in this business could take, because the title of your session was Pricing Strategies to Win, Profit, and Perform.
Absolutely.
And that's really the key. If you're just pricing to win and you can't profit or perform under that, you've just slit your own throat.
Yes.
So, and that's a painful way to go, let me tell you.
Yes.
So I wanted to thank you, Mike, for taking your valuable time to share your pricing strategies with us and the Fort Detrick Business Development Office group and team. I'd like to ask Steve to come on, and could you fill us in on what's happening at the FDBDO?
Yeah. Thanks, Gloria. And I'd like to explain what the FDBDO is. Fort Detrick Business Development Office. We are a free service available to companies interested in competing for business on federal contracts, specifically those contracts that support Fort Detrick. Now, our office does many things, but I will only mention a couple since we're short of time. We provide education and training to companies of all levels of federal experience, such as this webinar on proposal pricing strategies. In addition to the training, the FDBDO provides information on those solicitations that are released in support of Fort Detrick. Timing is important when addressing a solicitation, so we match up the solicitations with companies registered with us, and we email them to them. But those companies that are they're registered with us, so you have to be registered with our office in order to receive this type of information. You can register at our website. It's www.fdbdo.com, and you can also call us and set an appointment. We could love to meet with you one-on-one. It's 301-620-7071. And also I'd like to mention about our this webinar, in addition to prior webinars and upcoming webinars. All of our webinars are going to be posted on our website, and it's for free download, so that you could watch them 24 hours, 7 days a week. And we will also be available to respond to your emailed questions at that point in time. So you can find these webinars. This one will be posted in the near future at our Learning Library, at our website under, and you can find future webinars. Look under the calendar of events. Thanks, Gloria.
Absolutely. It's always a pleasure working with you. I learn something new every single webinar. And I've been around this market for a good while. It's always informative. And plus, the market's changing constantly. So even those experienced contractors are well served in taking advantage of the Learning Library through the Fort Detrick Business Development Office. I want to urge everyone to follow Steve's advice. Check out the www.fdbdo.com regularly for updated events, the resource library that is available to you as well. And you can touch base with Mike Gallo, our very informed subject matter expert today, at his information that's on the slide. His telephone number, 301-448-7578, and his email address is michael.gallo@Valerisis. I'm going to spell that one for you. V as in Victor, ALERISYS.com. Steve and Mike, it's a pleasure speaking with both of you. We're going to wrap up today's session now, and we'll look forward to the next webinar through the Fort Detrick Business Development Office. Goodbye,
Thanks, Gloria.
everyone.
Goodbye.